The investing landscape has shifted. The era of predictable, low inflation, and seamless globalization is over, replaced by competing blocks and fragile alliances. This scatterplot illustrates the complexity of this new frontier, mapping the dispersion of asset volatility against its correlation to inflation. We are looking at a market where structural inflation is higher and far more volatile than the previous decade. Historically, financial analysis happened on floors like desks, relying on human reaction times to process market shifts. That manual approach is being phased out by a physical and digital overhaul. This year, hyperscalers are projected to spend $737 billion on the specialized AI infrastructure required to sustain an automated economy. Relying on human reflexes in a market that rebalances in milliseconds creates an insurmountable lag, especially as the industry prepares for a $124 trillion generational wealth transfer. Agentic AI represents the newest phase of this transition. These are reasoning partners capable of monitoring every market interaction without a human in the loop. Software agents autonomously plan and execute multi-step trading strategies. They adapt to new data instantly, bypassing the need for manual human prompts. This capability has triggered an intense arms race. Institutions like Goldman Sachs, JP Morgan, and Citadel have collectively invested over $500 million in quantum and AI infrastructure to capture fractions of a cent before their competitors can move. Investors who continue to use the old analytical playbook find themselves sidelined. In a high-speed environment, the slow become the liquidity for the fast. To find an edge, these machines utilize multimodal AI, a superhuman sensory network that processes text, audio, and visual data simultaneously. This satellite image captures cargo ships waiting offshore. Algorithms use these visuals to quantify port congestion and commodity flows in real time, often weeks before the data appears in regulatory filings. This global map of nightlights serves as another data layer. AI monitors the intensity of light in specific industrial zones to verify factory output and gauge economic activity on the ground. These systems even analyze the exact vocal inflections of executives during earnings calls, detecting hesitation or confidence that a text transcript would miss. This continuous sensing allows machines to map supply chain disruptions and adjust positions before the news reaches human-led trading desks. The strategic brain is deep reinforcement learning. These agents learn optimal actions by interacting with the market, treating every variable like a puzzle. They constantly update their policy, running millions of simulations to find the single most efficient path to alpha. Powering this logic are hybrid systems like the IBM Quantum System 1, which provides the computational speed necessary for real-time optimization. A quantum system can run Monte Carlo risk simulations on a 1,000-asset portfolio in seconds. For a human team using classical computers, that same task takes hours. This combination of reinforcement learning and quantum speed allows major institutions to siphon market value with a precision that traditional firms simply cannot match. However, extreme speed creates extreme fragility. In a market where machines react to other machines, a single error can trigger a violent nonlinear collapse. During these flash crashes, algorithms execute their programmed math perfectly, but they lack the emotional intelligence to understand the context of a crisis or the weight of human panic. An algorithm doesn't feel the anxiety of an investor watching their retirement fund fluctuate or the pressure of preserving a generational legacy during a downturn. Algorithms manage the technical timing and volume of a trade, yet they lack the judgment required to answer why an investment strategy aligns with a client's core life vision. This gap has led to the Cyborg Advisor model, now used by firms like Morgan Stanley. It is a partnership that combines algorithmic precision with human wisdom. In this model, AI handles 95% of the execution, tasks like tax loss harvesting, rebalancing, and onboarding checks. This allows the human advisor to provide emotional alpha. This is the measurable financial value added by keeping a client disciplined and focused on their long-term goals during a machine-driven sell-off. Human advisors now use these automated tools to handle administrative work, shifting their own focus towards solving complex problems and navigating their clients' life transitions. Building wealth in this ecosystem doesn't mean betting against the machines. It means partnering with them. using algorithms to process the data while humans protect the future.